Welcome to Trade with Conviction, the show where we cut through the noise on oil, freight, and everything in between and tell you what the market's actually doing. I'm your host, June, putting on this cap for the very first time, and very happy to have Abhishek here today. Welcome. How are you, Abhishek?
Thank you, June. I'm good. How are you?
Doing very well, thanks. Well, I wanted our listeners to learn more about your background, Abhishek. Everyone knows I came from refinery, but how about yourself? Can you tell us more?
Yeah, that's correct, June. So I started my career with Reliance Industries in India with initial years in cargo operations, where I learned more about the physical side of trading, logistic, refinery, scheduling, vessel chartering. And then I moved to market analysis within Reliance, where I learned more about trading, hedging, and the factors which moves the oil prices. And since then, I have stints at LSEG and Letasco as distillate analyst, covering the fundamentals shaping the distillate market. In fact, I also ran a small spec book in my previous company, and it was a nice experience as I could express my analysis through trade. But I must tell you, June, having a market view is one thing, and managing the position is another. And traders out there, I hear you and I respect you even more after after doing the trading myself. So that's all from in very short about myself.
Yeah, very great to hear that, Abhishek. All right, then, let's go on with our show. We'll start with our headlines and what a week it has been. The calm has been broken. Would you mind running just through what has been going on with the Strait of Hormuz and where are we heading to?
Yeah, sure. I mean, it's been a very crazy 24-48 hours. The US Iran ceasefire came under fresh pressure after ships were attacked in the Strait of Hormuz, and Washington launched its largest strikes on Iran since the truce began. US also revoked the general license, allowing Iranian oil sales with only a short wind down period, pushing Brent prices sharply higher as traders covered their bearish position. Hormuz traffic otherwise had been recovering from around 30 to 60 transit a day before the latest, but flows remained well below pre-war level even then. And now 14 vessels reported on Wednesday, and today virtually none. The thing is, Trump said he believes the US-Iran ceasefire is effectively over, although negotiators are still allowed to continue talks, leaving the outlook uncertain. One part which is reassuring, June, is that he doesn't think the war will start again, though the peace deal and the process across this 60 days, in my opinion, will remain quite shaky.
Well, he doesn't think the war will start, but I think today we heard Kuwait and Bahrain getting attacked again by Iranian drones, right? Even Qatar is not spared now. So
Yeah, that's correct. That's what I think. Throughout this remaining period of out of 60 days, we'll keep seeing these skirmishes on and off. But what he means, I guess, is a full-scale war, what we had seen in the month of March.
all right then. But in the meantime, it's not just a flat price story. We have seen Brent spreads flipping back into backwardation. Latest I saw Augie SEP Brent swap spread is now close to 60 cents per barrel from minus 16 cents per barrel just 3 days back. We also see WTI Brent spread weakening. SEP WTI Brent is dropped from minus $340 per barrel to minus $490 per barrel. And product spreads are also strengthening, particularly for ICE gas oil. SEPOC is now at plus $37 per ton. Where and how about the supply angle?
Well, in the Middle East, OPEC Plus has approved another August production increase, taking the quota additions since the war began close to 1 million barrel per day. And UAE production rebounded above pre-war levels. In terms of buying, Indian buyers showed renewed interest in Iraqi crude, but it was heard that MRPL later cancelled an Aframax charter and is seeking a replacement vessel. And this highlights that the recovery in Gulf buying remains quite uneven. And the recent flare up also changes the equation to some extent. Iranian barrels had previously seen as a has been looking for another other supply option for buyers such as India and Japan. But after the US revoked the general license, those flows will now be much more difficult. In terms of inventory, global oil inventory remain heavily depleted after more than 1 billion barrel of lost supply and large coordinated reserve releases. The EIA expects most shut-in production to return by early next year and sees a large global stock surplus emerging by fourth quarter. Well, this has to be considered with a pinch of salt, as the situation in the last 48 hours has changed, and if situation remain escalated, I would expect further revision to those estimates.
Yeah, I think when the estimates were released, it was probably with the lens of a quick reopening of the Strait of Hormuz, which we now know is not that real. How about the weekly report? Any latest observations from there?
Yeah, the crude stocks built for the first time in 11 weeks. Commercial crude stocks, excluding SPR, rose 3 million barrels to 411 million. But SPR kept draining, down another 6.2 million barrel to 319.5 million barrel. However, there is a different story on the product side. Product stocks told a tighter story. Gasoline stocks fell close to 2 million barrel to 212 million barrel, 6% below the 5-year average, even as demand softened. Distillate stocks dropped 5 million barrel to 103.6 million barrel versus expected build, which people were thinking. And now we are about 12% below the 5-year average.
Sounds like a very distressed, right, in terms of the available inventory, particularly for diesel, from what I'm hearing now.
Yeah, no wonder we have seen the cracks and prices jumping, especially with the news coming from Russia and this Hormuz situation, and then stocks in US at very low levels. So, yeah, product inventories are quite tight. We will talk more about those when we cover the product.
All right. And I think coming to this angle now, will China save the global markets? Right. Everyone knows China has the most spare refining capacity right now, and they haven't been importing crude. So can they ramp up and help support some of the product markets elsewhere? Obviously, the emerging story is that authorities have approved the export of a combined 1.3 million tons of oil products in July. That compares with 2.5 million tons of clean product shipments in February before the war. Rongsheng is one of those that obtained approval, and they are an independent refiner. So flat price actually responded very favorably when this news broke out yesterday because it signals that China demand is back. And we saw Sing 92 cracks coming off at the back of this news because the Chinese exports would be geared towards more gas and jet fuel rather than diesel. So some people are talking about conspiracy theories. Did China allow these product exports to help Russia? I can't comment about that, but what I can observe is that we know that the Chinese buyers have stepped in to buy cheap discounted AG crudes. There's going to be more Iranian crude that has no buyers. It will end up in China anyway. And we also have Russian crude available with approximately 35% Russian refining capacity out. And this Russian crude is cheap. So it does sound like an optimal time for the Chinese refineries to start buying again. Now the question is, can they actually load the cargoes of AG that they have bought that are not, that has to go into the Strait of Hormuz to collect them? So it's anybody's guess right now, but I don't think that China is able to save the rest of the world in their refined products. Okay, maybe since we are about Russia, can you share some light about the state of Russian refining and how the European and Med refineries are coping with the heat wave?
Yeah, as you mentioned, June, there have been a series of drone attacks on Russian refineries, and the Russian refining system is under real pressure after those attacks. Several major refineries have been hit. Diesel output has fallen, exports have dropped sharply, and Russia has now banned outright diesel export or product export to protect domestic supply. What makes this more serious is that Moscow is also looking at product imports and lower fuel specification. To me, that shows the domestic balance is genuinely stressed and not just temporarily disrupted. One news which we were hearing early, contrary to rumors that Japan is supplying Russia with jet fuel, Japan clarified that jet fuel export ban on Russia also covers indirect and transhipment cargoes. The other point is that refineries restarts do not necessarily mean road fuel supply comes back immediately. Damage to secondary units or upgrading capacity can also take time under the pressure, even if crude runs begin to recover. By the way, before I move to the heat wave in Med, what do you think of this situation, June? I've seen our listeners or followers of your social media handle really loves your Refinery 101.
Thanks for sharing that. And a little bit of trivia. Today is episode 101. And I also like to do Refinery 101. Okay, so it's a bit opaque where the hits are at this point of time. If the drones struck the CDU, the crude distillation unit, there will be refinery downtime, and the most immediate hit is on distillate production. And you get more crude export, which is what is happening right now. Discounts on August delivery euros to India, for example, has widened to $10 per barrel or more, close to their widest level and back to near pre-Iran conflict levels as the Middle East supply returned. Now, if the drones struck the reformer, which is the unit in the refinery that produces more gas, you're going to get less more gas, but more naphtha exports from Russia if the CDUs remain running. And now, if the drone struck the important secondary units like the FCCs, the cat cracker, the hydrocracker, you're going to get less more gas and less diesel respectively, and more fuel oil exports from Russia, again, if the CDU is running. Also, it takes a bit longer time to repair damaged secondary units versus the CDU because you have a lot more sophisticated parts to source for replacement. So I don't have visibility of where the strikes actually happened, but we can look at the European product prices and cracks for the direction of the impact.
Yeah, fair point, June. As you mentioned, and also because of various sanctions in place, refiners will also find it difficult to get those right equipment or things to repair those unit or refineries. Let's go back to the topic of impact of heat waves on refineries in Europe. Refineries are largely coping with the heat, and we have not yet seen a broad wave of confirmed run cuts, but high temperatures reduce cooling efficiency, put more pressure on utilities, and increase the risk of unit trips or breakdowns, especially in the interesting part is that cracks are so strong that refiners have every incentive to keep running hard. So while the heat may argue for more caution operationally, refiners do not want to give up these margins. The Med heat wave is still mainly an outage risk, in my opinion, while Russia is already a realized supply loss. In the tight product market, even one unexpected refinery outage could have an outsized impact. I remember in 23-24, heat related run impact was around 10 to 15% of the capacity.
And are we anywhere near that heat wave temperatures right now compared to 2023, 2024?
Not exactly, but it's quite hot against the seasonally what it is there in the Med or Europe.
Okay, let me go to crude then. So we saw the fifth ADNOC tender since June, having about at least 16 million barrels of crude sold. Majority of the sold cargoes was Upper Zakum, which is the medium sour crude. It was heard at Dubai minus $4 to $5 per barrel level to Japanese, Korean, Chinese state-owned enterprises and independent refineries. And these are for July and August loaders. The interesting observation that I had was that the Chinese teapots were out buying. Previous tenders, they were not even in the buying list. So this indicates that the discount levels are now at a level that competes with Iranian and Russian alternatives. There were also cargoes of these ADNOC grades moving to US West Coast on private negotiation basis outside of the tender. And it's quite interesting because the ARB has not been open to US West Coast for so many years now. And I think I want to address the question that many people have in their mind. How can you be short of crude, and yet have a mini glut at the same time? This is actually a reflection of the mismatch of prompt availability of oil versus the natural trading window of oil 2 months ahead, for which the AG barrels should now be trading September loaders. And also refilling SPR. They will take a longer time because this is all government-owned stocks and tanks. They will need to issue tenders when the price is right. So what we have now is, or at least before the renewed strikes, was that Dubai went into contango, and any other to incentivize commercial traders and companies to store oil, the prompt oil. Any other excess oil that we see in the market has to up out, and the US West Coast, Northwest Europe receive some of these cargoes. So, but now we are back in a situation where prompt oil is taken away from the market due to the halted traffic in the Strait of Hormuz, and now we are returning to backwardation. So I think as I speak today, Dubai was in it was at the minus $1 per barrel a few days ago. Now it's closely going back to zero, and we might see a backwardation as well in Dubai very soon.
So, June, what does it mean for Brent Dubai spreads then?
If we're talking about, if I need to up the AG barrels to the west, a Brent Dubai EFS doesn't necessarily need to widen that much more because we had the diving crude premium that did most of the heavy lifting to keep the ups open into Northwest Europe and into the US. And needless to say, WTI is totally shut into the Far East versus Melbourne. But Japan, Korea, they will still likely buy WTI at a small percentage simply for diversification purposes. In terms of CPC, I'm seeing that it's still remaining quite cheap into Northwest Europe, but it's not workable into the Far East as well. How about we move into distillates market? Hot topic again, Abhishek?
Yeah, So, two of the major themes I had been discussing earlier, both of which could have had a big impact on the diesel market, have now actually come through. Russia has banned diesel exports, while China has relaxed its fuel export restriction. Just as the confidence around Hormuz was starting to improve, the latest attacks on vessels and Trump's comment have cast fresh doubt on how quickly flows can normalize. And on the same day, we got also the confirmation that Russia was banning the diesel export. The impact goes beyond Russia because the usual buyers of Russian diesel include Brazil, Africa, Turkey. They all need to compete harder for replacement barrels from India, Middle East, and USGC. And that is why European diesel crack have now surged to around 60 plus, even before supplies from AG could pick up. A market has lost Russian barrels. Even US diesel stocks, as we discussed earlier, reported drawdown and now hover near the bottom of seasonal 5 year lows.
So where do you see the up picture now? And are there any trade ideas you like from here?
If we look at the arrivals for the first half of August, Yanbu to Rotterdam is comfortably open. Houston is roughly flat on a larger vessels but still closed on an MR, while Sikka swing barrel works through Suez but remains closed via the Cape. To me, that still does not look sufficient, especially with Russian barrels now not available. What could become extremely important is China if the export relaxation translates into materially higher loading. That could provide some incremental supply relief. But even then, I would still expect the market to remain elevated. And now, with re-escalation in Middle East, everyone is unsure if China will lift the floodgates in August. And even in July, as we were discussing, it will be geared more towards gasoline or jet than on the diesel. So, given so many moving parts, it's really tough to give any trading idea. But I will prefer going short on HOGO swap, which is currently at 31 CPG, given how tight the European markets are.
All right. How about jet? Anything interesting there?
So, what was initially expected to be a jet story this summer when this conflict started has really become a diesel story now. The market has absorbed the initial supply shock surprisingly well, especially in Europe, which had been heavily dependent on AG jet supplies. Diesel has been outperforming jet, so August Singapore regrid has weakened. That has opened the jet arb from the AG and West Coast India into Europe on LR2, which should keep pressure on Northwest Europe jet pricing. In fact, European jet imports were at the highest level in June YTD. So the region is already receiving good replacement supply. In the east, the big question now is how much additional volume comes out of China following the July export relaxation. We are seeing a similar story on the US West Coast. Weak regrade in Asia is helping open East Asian jet hubs into US West Coast. So more barrels can move into Los Angeles. That should keep LA jet premium under pressure.
Yeah, very interesting. And I think the East-West also should be telling us some story, given that we are slightly weaker than in the West. So the diving premiums can still come off further, right? You think?
Yeah, yeah. I mean, East relatively West is much stronger, and that's why we have seen across both diesel and jet East-West weakening.
Okay, so I'll move into freight. We haven't given some attention to freight for some time. We have spent most of today's podcast talking about, the escalation part of the Strait of Hormuz. But let me take a step back and look at the contrarian view for freight. All these views coming from our trade expert, Michael Ryan, on a de-escalation path. So TD3C VLCC market, if we have a confirmed deal coming in, it will reprice the front month paper TD3 sharply lower as a risk premium evaporates. However, the forward curve will be slower to price the impact of Atlantic Basin migration. And as all the vessels cautiously reposition, the available AG spot tonnage is actually short relative to demand. So we do not expect VLCC rates to return to pre-war levels and expect crude landed costs to remain high, even if we see a very weak crude premium market, as what we heard, from the ADNOC tender before. On LR2s, CPP vessels have repositioned en masse from the AG, which should drive spot rates higher than when the AG barrels return. And as dirty Aframax earnings soften, LR2 vessels clean back up and eventually cap LR2 rates. However, the window between the initial cleanup and the normalization is likely several months. So during this window, the spread between TD5 and TC5 could widen dramatically. But with or without any escalation scenario, the East CPP MR market is near-term bullish. We are expecting more refined products to be exported out from the Far East, as they are again the supplier of choice into Australia and New Zealand. We expect the tonnage to be tight at the front and gradually ease as the ships reposition out of the Atlantic and countries restocking on products, supporting spot rates in the near term. This would, however, be followed by rate weakness as the market dynamics normalize and the fleet repositions. So before we go, if you want calls like this in your inbox, subscribe to Market Outlook, time, trader signals, and forward-looking analysis grounded in live Sparta platform data, free and built for traders. Sign up at spartacommodities.com/market outlook subscribe. Meanwhile, thanks Abhishek, and for the listeners out there, stay sharp, stay sane, and as always, trade with conviction. See you all next week.
Thank you, Jude.